To the right, to the right, to the right, to the left, to the left.
Stop it. All right, here we go. Back.
Welcome to another episode, TFT, Between Dollars to Dreams. We're happy to be here on another episode for you. And this episode is actually for you because you've asked the question. You've asked the question of, if I've got $1,000 to invest, what should I be investing in? First, before we get into that question, there are some things that you should know before you start investing. What are those things?
Well, know your client, right? So we've got to know. So it's not as simple as say, hey, buy NVIDIA.
Yeah.
It's basically, we need, the advisor needs to know about you. So we need to know your risk tolerance, your investment objective. What's that $1,000 for, right? And time horizon. There's a difference between saving and investing. Saving is for the short term. If that's the case, then you can't take risk, right? So I'm saving for the down payment to buy a house in 2 to 3 years. I can't afford to take risks and be in the market. Investing is typically for the long term. I'm investing for my kids' education. I'm investing for my retirement. So because it's a longer time frame, we could take on a bit of risk. So depending on who you are, so if you're conservative, if this is your first time that you're investing, we don't want it to be a negative experience. Right. So let's put into something that's a bit more safer and secure. So part of that money I would put into, let's say, a GIC or money market, and maybe another half of that I would put into a conservative mutual fund to kind of counterbalance. If the mutual fund doesn't go up as high, then hopefully the GIC interest or the money market interest will kind of counterbalance that.
So basically what Pierre is talking about is your asset allocation. He's going to ensure that you have a balanced approach there, most likely heading in. This is your first time investing. There's a lot of risk, of course, if you go full into the market. So to hedge against those risks per se, better choice of word could be used, but this is where you're securing part of that investment while you're keeping another part of it as the growth component of your portfolio. And of course, it doesn't necessarily have to go that way for everyone. That's where the conversation comes in. What are you using the money for? Am I going to use the money for my immigration expenses in about 3 years? Am I going to use the funds to buy a car that after I finish college or after I finish, I'm looking for a,
Having said that, that's really real now, because you want to buy a car.
I want to buy a car,
right? So you came to me. So where would you put the money that you saved up? Would you take a risk? Would you?
So first of all, what I would have done is, okay, if I know I'm going to buy a car, and of course I knew that conversation was had 2 years ago, I first used the vehicle that I think was most appropriate at that time for me, and that was my TFSA. So I put it in a TFSA, and in my portfolio, I knew I split it up, because you said that you can have more than one TFSAs, right? One for this purpose and one for that purpose. So opening multiple TFSAs, I had a car buying TFSA where I've mostly invested in safer stocks, because I don't want to lose the principal. I want to be able to make that initial down payment, so that the price that I eventually have to finance will be
your monthly payment will be
a little bit lower. And then also in that TFSA is also catering for the other expenses that I will have to initially pay. All right, like maybe there's an insurance, inspection, all of these things. Winter is coming up. Maybe I don't get the luxury of having winter tires. But there are many things you have to ask yourself. So what is your main purpose for this $1,000? Maybe you're looking to save the $1,000 because you're going to finish college next year and you want to go back home for a vacation. This is where you have the funds. And it doesn't have to be in a TFSA. You can put it in a high interest savings account, like our friend behind the camera likes to
the
use.
NEO high interest savings account.
So you use that as an to invest. But if if it's long term and you want to keep it in the TFSA, then that's fine.
The planes love us.
The planes.
Whenever
I think we're on a fly path.
Exactly.
We're on a fly path.
Exactly.
So that's why the noise. But what are some of the other things that, like, I remember when I spoke to you about first investing, you did say the banks, or you go there because you want to invest. But as I said, I could have also I think reduce some of my risk too if I used the segregated funds, the mutual funds, because there's a little bit of diversity, and I can have both growth. And when I look at mutual funds, because I've been looking at the market for a while now, I do see the kind of the kind of smoother line compared to stocks.
Yeah, because the mutual funds and segregated funds, which is the insurance version of a mutual fund, the main reason people buy mutual funds and seg funds is for that instant diversification.
Yeah.
So if I had owned $1,000 and I was a balanced investor with moderate risk, I would buy a Canadian dividend fund.
Yeah.
Right. And basically what that would have, it would have all of the bank stocks in it.
Yes.
A lot of the utilities, right? Like your Enbridge, Enbridge Gas, and any company that provides dividends. So a company that provides dividends basically says one thing: they're profitable.
Yeah.
If you're profitable, that's how you could pay dividends. So generally speaking, these companies are stable over a long period of time, which means you're probably not going to make a whole lot of money like you could if you go into a growth stock like Apple, but you could go to bed at night. And if they're not going up as high as you would want it to, they pay dividends. They return their profits every 3 months on a quarterly basis. And with those extra dividend payment, that cash payment that they provide you, you could buy additional shares of that.
And that's why I love the Canadian banks, because they're going to pay dividends, and they've been consistent for hundreds of years.
1880s, they haven't, Bank of Montreal hasn't missed a dividend payment.
That's why I love them. People are out there, they're thinking about investing. Energy is like the Suncors, have been good. The dividend, maybe not in terms of growth, and Enbridge as utility companies, as we all know. But we're not saying that that's right for you.
Yeah.
That's where you have to sit
have
down.
a conversation.
That's where you have to sit down with your advisor, sit down with the team at TFT, let them go through what's best for you, because really is understanding your end goal, understanding what type of risk you want to take. Maybe you're an aggressive investor, and maybe you're going to go into high risk stock, but the high risk stock can grow fast, but it can also lose a lot of money fast.
So, I mean, you're right with that. Sorry to interrupt you. Is that if you've got $1,000, there's not much in terms of diversification.
Right.
So this is where a mutual fund, aggressive fund, like you said, or a conservative fund or a balanced fund would be ideal, because you've got that immediate diversification. There's no point in buying half of a stock of Suncor, half of a bank on your own. Get the professional and have that instant diversification, and they're going to pay quarterly dividends, and you can buy more.
And especially if you're looking to go into funds, because of, as we've talked about throughout the video, it's important to work with someone, because to understand the MERs and all those technical terms, and what funds, what the composition of funds, if it's really suitable for you. You don't want to buy the wrong fund and then end up losing. And there's no guarantee of winning, but you don't want to lose knowing that you could have potentially been in the right fund at the end of the day. So just ensure that you're talking with your advisor. Talk with the team. If you don't have an advisor, reach out to us. We're happy to help you get into that investing journey, because it's something that I think a lot of people don't know about, and the potential benefits that it can have, and it's pretty exciting knowing that you have. And one of the things I want to end with also is, yes, you're going to invest $1,000 initially, but always think about how much can I contribute on a monthly or on a bi-weekly basis. So have a PAC,
a pre-authorized contribution,
and you can see that growth. And when you have that PAC, you don't even think about it, and you go back maybe a year or 2 years, you'll see the growth potential there. And
so for as little as you say, with that pre-authorized contribution, it's $25, right? It will make a difference. You may start out with that original 1,000, but that 25 you'll see as you're buying more frequently. Some weeks you'll buy more, other weeks you'll buy less units, but over the long term, you'll see hopefully the growth potential. All this to say, there's not a one size fits all. So definitely speak, if you deal with a financial institution, talk to your advisor at the bank or credit union. And if you don't, speak to one of us and we'll tailor a plan that's right suited for you.
That's right. So I think that ends it on a positive note. So contact us today, like, subscribe, post more questions to us so that we can answer it for you. And we'll try our best, of course. If we can't, we'll get experts to help you answer those questions. So from the flight path of one of Canada's busiest airports, this is us signing out on another episode. Continue doing the same, and we'll be back for a brand new episode. And he's invited me for Thanksgiving.
That's next episode. We'll talk about that.
Take care.
Bye for now.